Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Adobe Inc. quarterly report. Adobe Inc. offers a wide range of products and services across various segments. In the digital media segment, the company provides tools for content creation, including Photoshop, Illustrator, and Premiere Pro, which cater to professionals such as photographers, graphic designers, and video editors. This segment also includes services like Acrobat, which enables users to create, edit, and share PDF documents. The digital experience segment offers an integrated platform that helps businesses manage customer experiences across various touchpoints. This includes products and services for analytics, marketing automation, and commerce optimization. Adobe solutions in this segment cater to marketers, advertisers, and agencies, enabling them to create personalized experiences for their customers. In the publishing and advertising segment, Adobe provides e-learning platforms, technical document publishing tools, web conferencing software, and document management systems. The company also offers consulting, training, and customer support services to help businesses implement its solutions effectively. Adobe's products are licensed through various channels, including app stores, websites, and distributors. The company has a strategic alliance with HUMAIN for the development of generative AI models and AI-powered applications. With its diverse range of offerings, Adobe Inc. serves both enterprise customers and individual consumers worldwide. Adobe Inc. market capitalization of $97 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Adobe Inc. holds a significant advantage in their industry. Adobe Inc. trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 8.51 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through an analysis of the key trends in subscription and product sales. Revenue growth is primarily driven by the increase in subscription revenue, which rose by 13%. This growth was fueled by the expansion of Creative Cloud Pro, Acrobat, and Adobe Experience Platform. These products saw significant year-over-year increases, with Creative Cloud Pro growing by 12% and Acrobat growing by 16%. In addition to these specific product lines, the overall ARR, annual recurring revenue growth, was also driven by the contribution of hosting services, compensation costs, royalty costs, and amortization of intangibles. This suggests that Adobe's shift towards subscription-based models is paying off. On the other hand, revenue decline can be attributed to a decrease in product revenue, which fell by 5%. Services and other revenue also decreased by 19%, indicating a decline in non-subscription-based sales. Furthermore, Adobe stock experienced a decline, suggesting that this particular service may require attention to reverse its downward trend. Overall, the growth of subscription-based products and services is driving Adobe's revenue growth, while product and services declines are contributing to revenue decline. The net income of the company experienced a significant increase between 2025 and 2026. The net income rose from $1,811 million in 2025 to $1,889 million in 2026, representing a 3.4% increase. This growth can be attributed to various factors, including an increase in revenue and efficient cost management. However, the profit margins of the company showed mixed results during this period. The net income margin decreased from 31.7% in 2025 to 29.4% in 2026, indicating a decline in profitability. On the other hand, the operating profit margin remained relatively stable, increasing slightly from 37.9% in 2025 to 37.7% in 2026. The gross profit margin also experienced a minor decrease, dropping from 89.3% in 2025 to 89.1% in 2026. The reasons behind these changes are not explicitly stated in the provided information. However, it can be inferred that the company's revenue growth and cost management strategies played a crucial role in its net income increase. The decline in profit margins may be attributed to various factors such as increased competition, rising costs, or inefficient operations. The company is indeed generating positive operating cash flow. This can be seen in the significant increase in its cash and cash equivalents over a short period of time, from November 28, 2025 to February 27, 2026. The net cash provided by operating activities also supports this claim, with figures of $2,958, page 13, and $2,482, page 40. Furthermore, the operating cash flow for 2026 is a substantial $2,419 million, indicating that the company's operations are generating sufficient cash to meet its financial obligations. Management is optimistic about the company's outlook, citing a significant portion of remaining performance obligations that will be recognized within the next 12 months. This suggests a strong short-term focus, with approximately $22.22 billion in revenue expected to be generated over the next year. In terms of long-term growth initiatives, management expects continued expansion in software-based subscription revenue, driven by unified selling motions and integrated product innovation. The company is also harnessing the power of AI across its solutions to drive growth. Management has outlined several key strategies for achieving this growth, including the acquisition of Semrush Holdings, Inc., which is expected to close in the second quarter of fiscal 2026. Additionally, the company plans to continue investing in short-term and long-term investments, as well as purchases of computer hardware and server infrastructure. However, management also acknowledges several risks and uncertainties that could impact the company's business and financial results. These include the need to innovate in response to rapid technological or industry changes, potential reputational harm related to AI development and use, and vulnerability to service interruptions or failures of its information technology systems. Despite these challenges, management remains focused on driving growth and innovation, with a clear strategy for achieving long-term success. The company's financial activities have been documented in various sections of its reports. One notable aspect is the company's decision to buy back shares, which is mentioned on pages 25 and 41. This indicates that the company has indeed invested in repurchasing its own shares from the market. However, there is no information provided regarding the payment of dividends by the company. It appears that this detail was not included in the available reports or summaries. Concerns about inventory buildup and supply chain disruption are valid, particularly in the context of large-scale events that can simultaneously affect multiple customers. One such concern is the potential for supply chain disruption due to unforeseen circumstances, which could lead to inventory buildup. The use of third-party distribution platforms also poses risks, including the loss of key sales employees who have established strong relationships with customers. This not only affects customer loyalty, but also makes it challenging to secure a replacement distributor or partner in a timely manner. As a result, companies must carefully consider these potential disruptions when planning their supply chain operations. That concludes the financial summary for Adobe Inc. Feel free to comment below, and I will be happy to answer them when possible.